Today, we're diving into something that's really changing how our world works, often in ways we don't maybe fully grasp. We're talking about the Russia-Ukraine war, now in its fourth year, and how it's not just some distant conflict. It's actually a powerful force reshaping Western economies and, well, fundamentally challenging the U.S. dollar's long-standing dominance. Our mission for you, the listener, is to kind of cut through the noise, give you a concise, comprehensive understanding of the war's financial toll and its potential to really resculpt the global monetary order. We're drawing from the latest available data as of mid-2025. So let's unpack this. We're looking at how a conflict far away ripples through your daily life, from your energy bills right through to the strength of your currency.
Yeah, and what's fascinating here is just the sheer breadth of the impact. It's not just about the immediate sort of direct costs, right? It's more like a cascade effect on, well, everything. Energy markets, inflation, global trade, and even the fundamental structure of global finance.
Yeah.
So we'll explore the financial strain on Western economies first, and then I think pivot to the really intriguing question of how this war is challenging the bedrock of the U.S. dollar system.
Let's start there then with the financial strain. Maybe the most immediate, palpable impact, the one that hit everyone's wallets directly, was the shock to our energy supply. It felt like Europe was hugely reliant on Russia for its gas and oil. Can you lay out just how deep that dependency ran before the war?
You hit on something really important there. Before the war, yeah, Russia supplied about 35% of Europe's natural gas.
35%. Wow.
And get this, 60% of its oil. That was indeed a massive dependency.
Huge.
Now, Europe has drastically reduced its reliance on Russian energy by over 80% by 2025, which is a huge shift. But this hasn't been without, significant financial pain. Brent crude oil prices, remember they surged to $120 a barrel back in 2022?
So, yeah.
Well, they remain volatile, hovering around $90 to $100 in mid-2025.
Still high.
And European natural gas prices. They're still running about 30% higher than pre-war levels. That's according to the IEA, the International Energy Agency.
So that's a staggering transformation in just a few years, like
Yeah.
you said. But it certainly hasn't come cheap, has it? Can you give us a sense of the actual financial pain the cost European nations are enduring to make this pivot?
Precisely. It's been costly. Germany, for instance, spent a massive 20 billion
20 billion euros.
so just on new LNG terminals, liquefied natural gas. And they secured long-term gas deals with Qatar and the U.S. to replace Russian supply. The EU itself allocated 200 billion back in 2024 for energy diversification and subsidies.
200 billion.
Yeah, and that's funds directly diverted from other vital sectors like infrastructure and healthcare. It has knock-on effects. Even the UK, while less directly dependent on Russia, still saw household energy bills up 15% since 2022. That's from their Office for National Statistics.
And the U.S., what was the impact there?
Well, for the U.S., direct reliance on Russian energy was minimal, almost negligible. But those global oil price fluctuations, they've kept U.S. gas prices elevated. We're talking an average of $3.50 per gallon in 2025, up from about $3.20 pre-war, according to the EIA.
Right.
And this sustained pressure is one of the factors forcing the Federal Reserve to maintain high interest rates. They're still around 4.5% in 2025.
Which hits everyone with mortgages, loans.
Exactly. It impacts everything from mortgages to business loans, slowing things down.
And of course, energy was just the first domino, wasn't it? That surge in fuel costs quickly translated to, well, just about everything else we buy. What did that mean for our grocery bills and overall inflation?
Yeah, that's right. And this raises an important question about global food security, too, because Russia and Ukraine, between them, supply 30% of the world's wheat.
30%? That's
Yeah.
a huge chunk.
It is. And disruptions to that supply have kept prices stubbornly high. Wheat is still running about 20% above pre-war levels in 2025, according to the UN's Food and Agriculture Organization. Now, overall inflation has, thankfully, stabilized somewhat in Europe. It's down to 3–4% from that awful peak of 10% in 2022.
Okay, so some improvement.
Some, yes. But the cost of living crisis persists, especially when you look at stagnant real wages, particularly in places like the UK. In the U.S., inflation has cooled more significantly, down to 3% from its 9.1% high in 2022.
Still higher than we'd like, though.
Absolutely. Commodity price impacts continue to squeeze families, and the Fed's tight monetary policy, those high interest rates we mentioned, directly impacts borrowing costs for everyone. The European Central Bank, they're projecting about 3.5% inflation for the euro area in 2025.
And this pressure, it has real-world consequences beyond just economics, right?
Definitely. These persistent pressures have even sparked public discontent. We saw protests in France and Germany in early 2025, largely over economic hardship.
So it's not just about what things cost, but also how goods actually move around the world. What's the story with trade and supply chain disruptions? Has that eased?
That's another critical piece. It hasn't fully eased, no. Ukraine's Black Sea ports remain partially blocked, and Russia's restrictions on the Azov Sea have effectively halted commercial shipping there. This raises costs for essential commodities like wheat, corn, metals, shipping them globally.
So those costs get passed on.
They do. And European industries, particularly in Germany, had to make really costly, sometimes difficult shifts away from their traditional reliance on Russian metals and chemicals. There was a 2024 study by the London School of Economics, LSE, that estimated these trade disruptions alone cut European GDP growth by about 0.8% annually.
Wow, nearly a full percentage point.
Yeah. And we also saw over 1,000 Western companies, big names like Volkswagen, IKEA, exit Russia by 2025. The Kyiv School of Economics estimates their total losses at around $100 billion.
$100 billion?
And that naturally ripped through existing supply chains. Production costs in sectors like automotive, manufacturing, they rose by 10–15%.
And the U.S. impact on trade?
The U.S. had fewer direct trade ties with Russia, but it felt those secondary impacts, mainly through slower European demand for U.S. goods. U.S. exports to Europe actually dropped 5% in 2024.
Oh.
That's like trying to untangle spaghetti, a massive, costly logistical headache that's still being felt.
Beyond these broad economic ripple effects, these indirect costs, there are also the very direct financial commitments, Western nations supporting Ukraine. How much does this actually cost, and what kind of pressure does that put on domestic budgets back home?
It's substantial. By mid-2025, the U.S. alone had provided around $90 billion in military and humanitarian aid.
$90 billion.
Yeah. To put that in perspective, it's roughly 0.4% of its GDP. So a significant commitment, but still, a fraction of the overall economy.
Okay. And Europe?
The EU committed $100 billion. And some countries, especially those bordering Russia or Ukraine, like Poland and Estonia, they've led in contributions relative to their economic size.
Right.
Poland at 1.2% of GDP, Estonia 1.5%.
Really significant for them.
Very significant. And Germany, a major player, saw its big policy shift, the Zeitenwende, boost defense spending up to 2% of GDP by 2025. That's costing an additional $60 billion annually.
$60 billion more per year.
Which, understandably, sparked major debates over fiscal priorities at home. Should that money go to defense or other domestic needs? And remember, these expenditures are happening at a tough time during the post-COVID recovery phase.
Right.
So in the U.S., this aid directly competes with pressing domestic needs, infrastructure, social programs, and that fuels intense political debates. And in Europe, some countries, notably Hungary and Slovakia, have voiced skepticism. They argue resources are being diverted from their own urgent domestic issues.
So that creates fiscal strain long term?
Potentially, yes.
Yeah.
It definitely risks long-term fiscal strain across the continent.
And what about the financial markets themselves? We touched on commodities, but what about stocks, currencies? How has the war played out there for investors?
Well, European stock markets, particularly in Germany and Poland, saw notable losses, maybe 5–10% during 2024. That's according to MSCI data. The U.S. market, while generally more resilient, still experienced bouts of volatility. The S&P 500 dipped about 3% in early 2025 amid renewed uncertainties tied to the conflict.
And the Russian side? The ruble.
The ruble. Its dramatic collapse down to 150 against the dollar back in 2022 has sort of stabilized, but it's still weak, around 100 to the dollar in 2025. But the bigger story is that international sanctions continue to effectively isolate Russia's financial system.
Yeah.
That creates these indirect ripples across global markets, mainly through those commodity price impacts we talked about.
Okay, let's shift gears slightly, because here's where, for me, it gets really interesting. This war has thrown a massive spotlight on the U.S. dollar. It's been the world's dominant currency forever, it feels like. But now there's serious talk of de-dollarization. What exactly is driving this trend, and, how is it playing out?
It's a crucial shift to watch, absolutely. The catalyst, really, was the scale and scope of Western sanctions. Freezing around $600 billion in Russian central bank reserves, cutting Russian banks off from SWIFT, the main global system for financial messaging.
Unprecedented action.
Totally unprecedented.
Yeah.
They aimed to cripple Russia's economy, and they did cause a big hit, about a 4% GDP drop in 2022. But what's fascinating, as you say, is how Russia has adapted. They've aggressively increased trade in non-dollar currency.
The yuan.
Especially the Chinese yuan, yes. It now apparently accounts for 30% of Russia's trade, according to their own central bank data. And President Putin, in his 2025 Valdai speech, he reiterated calls for a, quote, depoliticized financial system, meaning one where financial tools like sanctions couldn't be, well, weaponized by one nation or bloc for political leverage. And Russia's also boosting its gold reserves. They're expected to hit 25% of total reserves by 2025. And they're actively exploring this idea of a new BRICS-based currency.
BRICS being Brazil, Russia, India, China, South Africa.
Exactly. That economic bloc.
So Russia's actions are partly, maybe largely, a direct response to the sanctions hitting them. But are other nations watching this and also thinking, maybe we need alternatives too? Perhaps wary of the dollar's power being used as a geopolitical tool down the line.
That's precisely the concern. And yes, others are watching very closely. Other nations witnessing the, frankly, sweeping power of dollar-based sanctions are indeed exploring alternatives. China, for example, has significantly increased yuan-based trade with Asian countries. India settled about 10% of its trade with Russia in rupees in 2024.
Okay, so concrete examples.
Yes. Now, these shifts, we should be clear, are still relatively small in the grand scheme of global finance. But they do signal a growing push for alternatives to the dollar. The dollar's share of global foreign exchange reserves is now down to 58%.
58%? What was it before?
It was around 71% back in 2000, according to the IMF. So it's a noticeable slide over 2 decades. It's less about, a sudden collapse and maybe more about a gradual erosion of absolute confidence in the dollar's invincibility, maybe.
That's a fascinating trend. Yet despite these efforts, despite this talk, the dollar still seems incredibly strong right now, doesn't it? What does this mean for its current strength, and how does that affect other countries, especially developing ones?
That's the paradox, isn't it? So the war, especially initially, actually strengthened the U.S. dollar significantly. The DXY index, that's the measure of the dollar against other major currencies, it hit a 20-year high back in 2022.
Right.
And in 2025, the dollar remains strong. It's appreciated about 5% against the euro and 8% against the yen just since 2022.
So good for U.S. tourists, maybe?
Good for U.S. tourists and consumers buying imports. Yes, it lowers those costs. But, and this is a big X here, but it significantly raises debt servicing costs for emerging markets that have borrowed money in dollars.
Ah, because they have to pay back more in their local currency.
Exactly. Imagine having to pay back a loan in a currency that suddenly got much more expensive relative to yours. It puts immense strain on their economies. And that indirectly affects Western trade partners, too, because those strained economies buy less. The IMF actually estimates that the strong dollar shaved about 0.5%, 0.5% off global GDP growth in 2024 alone.
Wow. Okay, so this raises the really big question then. What are the genuine long-term risks to the dollar's dominance, even with its current strength? Is this de-dollarization talk just noise, or is there fire behind the smoke?
I think the war has definitely exposed some inherent vulnerabilities in the dollar-based system. It's made them clearer. The sanctions, while effective in the short term against Russia, have prompted major players like Russia and China to actively, strategically seek ways to reduce their dollar reliance long term. You have the BRICS nations seriously discussing a potential digital currency platform in 2025 as an alternative settlement system.
A BRICS digital currency, that would be a huge development.
It would. Let's keep perspective. The dollar's role as the world's primary reserve currency, the main currency for global trade, that remains overwhelmingly secure for now. Something like 88% of SWIFT transactions are still dollar-based. The infrastructure is just dominant.
88%.
Okay. But these concerted efforts by a growing number of nations, including major economies, they could gradually erode its dominance over time. It's chipping away at the edges. There was a 2024 IMF report that explicitly warned that a more fragmented global financial system, one with competing currency blocks, could increase global transaction costs by 1–2%.
Making everything more expensive again.
Exactly. Making global commerce more complex, more expensive for everyone.
Okay, we've covered a lot of ground on the economics, the currency shifts. But beyond all the numbers, what about the human and political impact back here in the West? How is this conflict and its economic fallout rippling through our own societies?
That's crucial, too, because the war's economic toll has undeniably fueled political unrest in the West. We can see clear links. In Europe, we've seen populist parties, Germany's AfD, France's National Rally gain significant ground in the 2025 elections, and they've capitalized directly on public frustration over the high cost of living and the continued financial aid being sent to Ukraine.
Tapping into that discontent.
Precisely. And in the U.S., debates over continued aid have definitely intensified. Some lawmakers are arguing much more forcefully that it unfairly burdens taxpayers, especially when domestic needs are so pressing.
So what's the ultimate risk there?
Well, the risk is that this combination of public discontent and political division could weaken transatlantic unity and support for Ukraine over the long haul. And indirectly, that could even affect the dollar's global influence, because part of the dollar's strength comes from the perception of a unified, stable West. If that unity falters, well, it adds another layer of uncertainty.
So summing up then, what we've unpacked today is this truly complex tapestry, isn't it? All these interconnected impacts, from energy prices and inflation hitting our wallet directly, to these huge global trade disruptions, massive aid commitments, and then these fundamental shifts that seem to be challenging the dollar's global role. It's just a stark reminder of how deeply geopolitical events ripple through, well, every aspect of our lives.
It really is. If we try to connect this to the bigger picture, maybe the final thought to leave listeners with is this question. As global alliances continue to shift, and as nations increasingly seek alternatives to the established financial order, what does a more fragmented financial system actually mean? What does it mean for international cooperation, for global stability in the coming years? And maybe more personally, how might that ultimately influence the financial landscape that you have to navigate in your own life?